Welcome to this explainer, where we're taking the seemingly dry rules of Vietnamese Accounting Standard 02 and uncovering the hidden journey of a company's trapped cash, its inventory. You know, when you walk past a massive warehouse, you might just see a bunch of boxes stacked on shelves, but look at it through the lens of accounting and you're actually watching a living, breathing financial life cycle unfold right in front of you.
But before we dive into the nitty-gritty technicalities, we have to ask a pretty foundational question. How do we actually distinguish a warehouse full of valuable assets from one that's just hiding a massive financial liability? Because let's face it, $1 million of unsellable product isn't a $1 million asset, it's a $1 million problem. So how do we stop companies from artificially inflating their worth with useless, aging stock?
To figure that out, we're going to follow the complete life cycle of inventory through 5 logical stages. We'll look at the nature of inventory, its historical cost structure, costing methods, devaluation provisions, and finally, recognition and presentation. Think of these 5 steps as strict guardrails for financial transparency.
All right, let's kick things off with stage 1, the nature of inventory.
What actually qualifies as inventory under VAS 02 is honestly much broader than most people think. It's not just finished goods sitting pretty on a retail shelf. Inventory represents physical assets at various different stages of their journey toward actually generating revenue. Whether we're talking about a fully finished car, a half-assembled chassis on the factory floor, or just the raw steel waiting to be cut, the accounting standard treats all of it as inventory, because it's all pushing toward the exact same goal, making a sale.
The true scope here is vast, spanning everything from raw materials and tools to works in progress and finished goods. But there's a really fascinating detail in the mix. Even the costs of incomplete services count. Think about the labor and direct costs piled up on a consulting project that hasn't been billed yet. Yep, under the standard, that counts as inventory too.
Moving right along to stage 2, historical cost structure.
When an item finally enters that warehouse, we need to know exactly how much it cost us to get it there. That historical cost is meticulously built out through 3 distinct steps. First up, you have the purchasing of materials, which wraps in the price, non-refundable taxes, and shipping, minus any trade discounts, of course. Step 2 is conversion costs. This is the direct labor and overhead required to physically transform that raw material into a product. And Step 3 covers any other direct costs needed to get the inventory to its present location and condition, like, say, custom design fees for a very specific client order.
Now here's where it gets really interesting. Fixed overhead allocation has to be strictly based on the normal capacity of your production machinery. Why does this matter? Well, if a factory is only running at half capacity, VAS 02 strictly dictates that you cannot stuff all those idle fixed overhead costs into the value of the few products you actually manage to make. Normal capacity is your average production level under standard circumstances. If your production suddenly drops, those unallocated fixed overheads, things like factory rent or machinery depreciation, they have to be written off immediately as an expense in the current period. You can't just hide them away to inflate your inventory value.
This distinction is absolutely vital because the standard specifically blocks things like abnormal waste from artificially pumping up your inventory's worth. Think about it. If a machine breaks down and destroys an entire batch of materials, that mistake is a period expense. It is definitely not an asset. The same logic applies to general storage costs unless they're absolutely necessary for the production process, along with selling and administrative costs. Keep those strictly out of your inventory valuation.
All right, our goods are valued and sitting patiently in the warehouse. That brings us to stage 3, costing methods.
How do we actually calculate the value of these goods when they finally leave to be sold? Well, there are 4 acceptable methods for costing those inventory outflows. First, you have specific identification, which tracks the exact cost of unique, usually high-value items. Then there's weighted average, which is great for smoothing out price fluctuations over time. Next is FIFO, or first in, first out, assuming the oldest stock is sold first. And finally, LIFO, last in, first out, which assumes the newest stock goes out the door first. Keep in mind, the method a company chooses here is a massive deal. It can drastically impact their reported profits, especially when the price of materials is bouncing all over the place.
But what happens if those goods don't leave the warehouse and just sit there, gathering dust? That triggers stage 4, devaluation provision.
This acts as a crucial reality check in accounting. We have to ask the tough questions here because, remember, inventory is trapped cash. If it's damaged, totally out of style, or technologically obsolete, its value on paper absolutely has to reflect reality. You can't just point to a warehouse full of unsold 5-year-old smartphones and claim they're still worth exactly what it costs to manufacture them. That's just not how it works. To solve this, VAS-02 uses something called Net Realizable Value, or NRV. Basically, it demands that at the end of the year, you compare the original historical cost to the NRV. The NRV is just what you realistically expect to sell the item for, minus any costs you need to finish it and actually make the sale. If that NRV drops below your original cost, you have to write down the inventory value immediately by creating a provision. No exceptions.
Well, actually, there is one brilliantly logical exception. Raw materials are totally protected from devaluation as long as the finished product they'll eventually become is still profitable. Let's say the market price of raw steel plummets. You don't actually have to write down your steel inventory, provided the heavy machinery you're building with it will still sell for a profit at the end of the day. It makes perfect sense when you think about it. Outside of that, the standard is pretty strict. You've got to calculate these devaluation provisions item by item, and it has to be based on highly reliable year-end evidence. You can't just slap a blanket 10% discount across the entire warehouse and call it a day. But accounting is fair. If the market suddenly recovers in the next accounting period and the NRV shoots back up, you can actually reverse that provision, restoring the inventory value right back up to its original cost.
Finally, our inventory is sold and leaves the warehouse, taking us to our fifth and final stage, recognition and presentation. This final step perfectly illustrates the matching principle. When the inventory is sold, its value moves from the balance sheet over to the income statement as the cost of goods sold. This basically guarantees that the expense of the inventory perfectly aligns with the revenue it generates, giving everyone a crystal clear picture of the profit margin for that specific period. Transparency is the name of the game here. VAS-02 requires full disclosure on the financial statements. You've got to state your costing methods, the total carrying amount of your stock, any provision balances, any reversals you've made, and, this is a big one, any inventory you've pledged as collateral for debt. Investors absolutely need to know if a bank actually has the first claim on the goods sitting in your warehouse.
Also, if you opted for the LIFO costing method we talked about earlier, VAS-02 throws in one extra hurdle for you. Because LIFO can artificially depress inventory values on the balance sheet during times of inflation, you have to explicitly disclose the difference between your LIFO valuation and what it would have been under FIFO or current value. This is purely to ensure there are no hidden reserves being kept from whoever is reading those financial statements. Ultimately, as we wrap up this explainer, keep in mind that mastering these valuation rules isn't just a box-ticking exercise for compliance. It's about revealing the absolute, unvarnished truth of a company's operational health. If you can understand the life cycle of inventory, you literally hold the key to understanding a business's true profitability. So, the next time you're digging into a company's financials, ask yourself, what story is their warehouse really telling?